Last night, while most of America was asleep, one of the most important market events of 2026 happened. Oil crashed 19% in a single night. The Dow futures spiked 967 points. Nasdaq futures jumped nearly 3%. And your portfolio either just got a massive gift or it's about to get taken to the woodshed, depending entirely on what you own. So today I'm going to break down exactly what happened, what it means, and the 3 specific places your money should and should not be right now. Here's the 60-second backstory. 6 weeks ago, the US and Israel launched strikes on Iran. Iran responded by closing the Strait of Hormuz, a narrow waterway that 20% of the world's oil passes through every single day. Oil shot up 70% since February. Energy stocks became the hottest trade on the market, and everyone else, airlines, retailers, consumers, got absolutely punished at the pump. Then last night, Trump posted a Truth Social message agreeing to a 2-week ceasefire. Iran accepted. The strait is reopening. And overnight, oil dropped from $117 a barrel all the way down to $94, the biggest single-day oil drop in nearly 6 years. Now here's what matters to you. This isn't just a headline. This is a rotation event. Money that was sitting in one place for 6 weeks is about to move fast. And if you know where it's going before the rest of the market catches up, that's how you win. Trade has-hone. Get out of energy stocks, or at least trim them. This is the uncomfortable one. Energy has been the single best performing sector of 2026. The Energy Select Sector ETF, ticker XLE, was up over 34% just this year. The United States Oil Fund, ticker USO, was up over 100% year to date. If you've been holding either of these, congratulations, you made money. Now it's time to have a serious conversation with yourself about what you're still holding. Because here's the reality. Oil went from $67 before the war to $117 at the peak. The war premium, the extra fear baked into the price, was enormous, and with a ceasefire in place, that premium is unwinding fast. Analysts are already pointing out that even at $94 a barrel, oil is still way above where it started, which means there's more downside if this ceasefire holds and the strait fully reopens. The easy money in energy is gone. Holding on now isn't investing, it's hoping. And hope isn't a strategy. Trade #2. Look at airlines seriously. I know what you're thinking. Airlines? Really? Yes, really. Here's why. Jet fuel is the single largest operating cost for any airline, typically 25 to 30 cents of every dollar spent. When oil was at $117, airlines were getting absolutely crushed. Their margins were evaporating, and their stocks reflected it. Delta Airlines, which reports earnings today, was sitting near its lows for the year heading into this morning. American, United, Southwest, all of them have been the unloved, beaten down corner of the market for 6 weeks straight. Now oil drops 19% overnight. For every $10 per barrel decline in crude, U.S. airlines collectively save around $3 to $4 billion in annual fuel costs. A 19% drop isn't $10. It's more like $20 off the peak. Do the math. These companies just got handed a massive earnings tailwind before breakfast. Delta's report today drops into a completely different environment than it was expected to. If you've been looking for a beaten down sector that just got a real fundamental catalyst, transportation and airlines just became the most interesting trade in the market. Trade #3. Think twice before chasing the S&P rally this morning. This is the hardest one to say because nobody likes being the person who pumps the brakes during a party. But I'd be doing you a disservice if I just told you to buy everything and send it. Because here's what the smart money is quietly noting this morning. This ceasefire is 2 weeks long, not permanent, not a peace treaty. 2 weeks. Iran's own statement said this is not the end of the war. GasBuddy's chief analyst said plainly that a 2-week ceasefire likely means another 2 weeks of barely anything getting through the strait, meaning oil prices could actually creep back up. So what you're watching right now is a relief rally. Relief rallies are real, the gains are real, but they are not the same as a fundamental shift in the market. If you already own broad index funds, great, you're going up this morning and you don't need to do anything. But if you're thinking about deploying new cash into the S&P at a 2% gap up open purely because of a 2-week ceasefire, that's chasing. And chasing is how Dave from our last video ends up explaining missing money to his wife. The bigger picture, nobody's talking about. Here's what I want to leave you with. While everyone is celebrating oil coming down, inflation doesn't reverse overnight. Gas prices at the pump lag crude by weeks. The structural damage to supply chains from 6 weeks of Hormuz being closed doesn't fix itself because of a Truth Social post. And the US deficit, treasury demand issues, and stretched market valuations, all the things keeping gold at all-time highs, none of that changed last night. The ceasefire is good news, genuinely, but markets have a habit of pricing in the best possible outcome before confirming it actually happened. 2 weeks from now, we'll know if this thing is real. Until then, the most important thing you can do is not confuse a relief rally with a resolution. Trim your energy exposure. Take a serious look at airlines and transportation. Don't chase the broad market gap up with fresh cash. And keep some dry powder ready, because in 2 weeks, this story has at least one more chapter. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." For the last 6 weeks, fear ran this market. This morning, greed is back. back. The question is whether you want to be the one selling into it or the one still buying.